Hello and welcome to the Mutual Fund Show. I'm Shah. I'm coming back on the show after a while, but it's good to be on the show again. I love it. And as is the norm, we'll talk about some key topics regarding mutual funds. Now, it's often said in investing that concentration may be a good or a bad thing, but getting overly concentrated on a particular theme or a particular stock may not be a great idea. Now, in the same parlance, you might inadvertently be getting concentrated as far as your mutual fund portfolio goes. And by that, I don't mean buying more units of the same fund, but by buying inadvertently the themes which the mutual funds have in the backdrop. It's a difficult proposition to track at every single point of time. Maybe advisors do that, but if you're a DIY investor, then it might become really difficult. So how to look at or whether overlap is a good or a bad thing, how to look at what quantum of overlap is a good or a bad thing, and how to correct that, if you will. I think we'll talk about that over the course of the next 15 to 20 minutes. Both our guests coming on the show today, Prableen Bajpai of FinFix and Kartik Shah of MMI Investments join us on the show. Both of you, thank you for taking the time out. Lovely having you. Prableen, if I can start with you, when you are advising your clients, is the issue of overlap of the stocks behind the mutual fund portfolio assume significance when you are advising a particular client?
Hi, Neeraj. Great to be on your show and good to see you back on the show. I think that is one of the considerations for sure while constructing a portfolio, because I think the very idea of adding more schemes to a portfolio is based on the concept that you're able to diversify the portfolio. And let's say by adding more number of schemes, you are actually giving the same exposure, the same stock exposure to the investor. So somewhere that purpose is defeated and you end up adding, the number goes up in the portfolio. The size of the portfolio becomes bigger. So definitely that is a consideration. But having said that, Neeraj, overlap is one of the little things that one needs to see, because it is a factor which is dynamic in nature and it won't be constant. So I think there has to be definitely, while creating a portfolio, while adding a new scheme or even, investing in an NFO, that has to be somewhere at the backdrop that, yes, am I adding a new theme or am I going to get the same exposure to sectors themes? But to some extent, I think, overlap is unavoidable and cannot be the only criteria, but yes, has to be checked while adding or creating a portfolio.
Oh yeah, most certainly cannot be the only criteria. But a lot of times people may not even be realizing that they are getting into an overlap situation. And hence we thought we'll kind of discuss this in threadbare for the next 10 to 15 minutes. Kartik, let's get you in on this conversation. When you are talking to your clients or thinking about your client's portfolio, do you look at the overlap that may be there in the fund? How much of weightage or importance do you give to this, and why so?
We need to understand what we mean by a portfolio overlap. So basically, it is just not the number of stocks which are common between two funds. It is actually the weight of the stocks which is common. So for example, two funds can have fewer stocks in common, but if the allocation to those stocks is higher, then the overlap is also high. So there are tools which are available. So the proper overlap has to be done when you are analyzing a client's portfolio. Second point I want to make is, first we can also discuss how do clients actually end up having so many funds. Now, I have seen two reasons broadly when I meet my clients. One is endlessly chasing of NFOs which come. This is because of the aggressive marketing pitch by AMCs and the relationship managers through which they buy NFOs. And second is, at times they tend to chase the performing funds, as in performing funds in the short term. So which are the top performing funds in the last 1 year, they try to chase them. Because of that, they keep on adding funds without realizing whether duplication is happening or not. And I have seen clients having 15, 20, 25 fund schemes, out of which 10 to 15 have duplication of 60 to 70%. So that can be avoided and those funds need to be proved.
Okay. So to your mind, Kartik, what is to your mind for your clients a higher overlap, independent of the number of funds, and we'll come to those reasons as well. But what is the higher overlap percentage, if you will?
According to me, anything over 60 to 65% is a higher overlap. Of course, there are categories in which overlap is inevitable. For example, in the large cap fund space, overlap will happen.
Yeah.
But even in large cap funds, I have seen overlap of around over 70%, which is way higher. So,
got it. Prableen, that would be, two factors which Kartik spoke about seem almost obvious reasons for this. One is in a large cap fund, because of the restriction on the number of stocks of the universe, you might have the overlap. And two, something that we speak about so many times, the way people chase NFOs because it's coming at the 10 rupee face value or 10 rupee NAV. And does that kind of lead to something like this happening, especially for a DIY investor, Prableen?
Absolutely, Neeraj. So, because when I think we are constructing our portfolios and specifically our own selves, we are looking at the names. So, let's say an investor is looking to has a large cap fund is now looking to add a flexi cap fund. I think in his or her opinion, he's making the right choice or she's making the right choice by adding a new category without realizing that maybe the underlying stocks are, very high in terms of the overlap. I'll give an example here. What often happens is that if you're comfortable with a fund house or you like the performance of a particular AMC, I think you also tend to go in for another scheme from the same AMC.
Mm-hmm.
So I'll pick an example here for Quant, for example. The Quant tax plan and the Quant flexi cap fund, both of them actually have a high overlap of about, which is 75%. So they have about 24 stock holdings which are overlapping. And I think it's not the numbers, but the overall weightage wise, it's coming out to be about 75. So probably for someone who's actually looking to increase exposure to, let's say, a scheme from Quant and has the tax saver, might as well, increase their exposure there without adding the flexi cap fund, because he or she is going to have the same sort of an investment philosophy and the stocks are, pretty much the same. So we feel that, we are adding a different category, but we are going one step, ahead and then checking the overlap is somewhere important. And there is no drawback to it other than, I think, two major things. Number one, that your portfolio starts becoming quite huge because you're looking to diversify. The diversification is not happening. And secondly, that, if there is the downside risk, what we call the concentration risk, also to some extent goes up. And in times when schemes are doing fine, it's good, we want to add more and more from the same fund house. But, when things don't work well, for example, we saw, Axis struggle a bit. Then what happens is almost all the schemes from the same fund house are struggling. And that is also because of the common sort of an investment philosophy and the stock universe that they usually invest from.
Yeah, and this is important, Prableen, right? But just a clarification, viewers, if you're listening to Prableen right now and thinking of, the Quant Flexi versus Quant Tax Saver, keep in mind a tax saving fund would have that 3-year lock-in. So please bear that in mind. But Prableen, this is an important point also because usually this is seen in so many investors and so many queries that come to us as well, that when a fund of a particular house starts doing really well, people tend to look at the other schemes from the same fund house because they believe the chances of those schemes also doing as well in the year ahead might also be high. So that's a very common cause, I would presume.
Yes, it is. And that's okay, Dheeraj. You can always have faith in a fund house.
Yeah.
But then I think where the investors need to be careful is, so let's say if I like HDFC, so it's okay if I'm adding HDFC top 100 and I'm adding the mid-cap opportunities, because the overlap between those schemes, because of the very construct and the mandate requirements, will not be very high. But whenever we are adding, let's say these, wherever the flexible sort of funds where we have the flexi caps and large caps, usually that is where we are seeing the problem, because flexi caps have that, freedom to move around across the market cap. So because of the mandate requirement being different, I think these are the categories where we see a higher side, overlap. Otherwise, I think across the different segments, like, the schemes which are there, mid cap, small cap, the overlaps are not very high, even within the same fund house, although they don't get the diversification in terms of style of management.
Yeah. And viewers, keep in mind at some point of time on the mutual fund show series, we'll also talk about over diversification, because frankly, if you have too many funds and too many stocks, then you're virtually buying the Nifty 200 or the Nifty 500 basket, which may also not serve its purpose. But Kartik, I'll come to you. That is for another time. For today's show, Prableen spoke about a couple of examples. You've given an example of a couple of different fund houses, wherein if people were to choose those funds, then the overlap percentage is very high. So tell us a bit about this and why is this avoidable? Like Prableen was saying, Kartik, it's not necessarily a bad thing, but it's something that people should keep in mind.
See, first of all, I think the more the funds a client has, it becomes difficult to manage and to track.
Sure.
So if the duplication is higher, the whole idea is to keep one fund and let go of the other. We are not saying that the funds are not good in their own. So let's say in the large cap space, one of the example I was seeing is Canara Robeco, Blue Chip and Multiasset large cap. Over 67% of overlap. So now the funds, the companies which are not in common, the relative outperformance of that is not going to change the fund performance of either. So it becomes prudent for the client to keep either of these two rather than having both. And maybe invest the money in some different fund where the overlap is lesser. I mean, as Prableen rightly mentioned, there are categories where the overlap is lesser. So, if the client invests in those categories with multiple funds, he gets more diversification. He allows his portfolio a chance for exposure to different market segments rather than just one particular market segment. I will just take another example of an AMC. Now, we have seen that certain times the AMCs tend to favor certain stocks or certain stock segments. Now, it is evident across market categories at times. So, if you take Canara Robeco Blue Chip and Canara Robeco Flexi Cap, the portfolio overlap is around 77%. So, I mean, there is no use to keep both the funds. Rather, reduce a fund and then take the money out and put it on some other fund. So, this is what I would say.
Okay. Kartik, let's assume this investor, she's watching us right now and trying to understand that, hey, having too many schemes is also bad. Having too little also might not be great because that would be over concentration. And if, like Prableen said, a particular fund house goes through a slightly tough phase, then the overall portfolio percentage doesn't benefit from the power of diversification as well. So to your mind, and I'll ask the same question to Prableen after that, but Kartik, to you first, what is the ideal number of scheme that you believe an investor should start with? And for somebody who's been around and investing for the last 3 to 5 years, because that's the majority of our viewers and our readers, what is the optimum number of fund schemes that one can have?
So it's a very broad question in itself, but we'll just try to...
Let's assume standardized things, 30-year-old earning average income with an average risk appetite.
And we are talking only about equity funds, right?
Yeah.
So I think to start off with, 2 to 3 funds for the beginner is good enough. As he becomes a seasoned investor, like in your case, you said your viewers have that experience, then 6 to 8 fund schemes are good enough. Additional scheme needs to be introduced only if it is giving a diversification which is not available presently in the portfolio. I'll give you an example. Let's say the investor does not have exposure to US stocks. Then it makes sense for him to go for a NASDAQ 100 or S&P 500. Or if he is a high-risk investor and he feels that a particular segment or sector will do well, then he can go for a sector fund. But otherwise, according to me, 6 to 8 fund schemes across the universe is good enough.
Got it. Prableen, this viewer is watching you. She wants to know what is your view on the ideal number of schemes as a starter and as somebody who spent 3 to 5 years and has some bit of mutual fund exposure. What would your views be?
So I think, Neeraj, if you're starting off, on a clean slate, it's easy. You first start off with the 3 broader categories, assuming that, it's the long-term portfolio and risk appetite is towards high. So, you cover the large cap space, then you cover the mid cap space and you cover the small cap space. So, just one fund from each of these categories. And in the large and the mid cap, I think even a passive strategy can work. And in the small cap, probably an active fund. So there you're very sure that you're covering, the broader market, what the Indian stock markets are offering. So that's one thing. If you have the appetite and you're comfortable investing abroad, then you add another layer of diversification. Like Kartik mentioned that, then you can diversify geographically and add something like a NASDAQ 100 or S&P 500. That's another thing. And then maybe a bit of gold. Even through mutual funds, I still feel that it's a good way if you're looking to invest a small amount on a regular basis. So you have the asset-wise diversification also here. And then you are having within equities, you're having the market cap wise diversification. And I think there will be very minimal sort of an overlap, maybe very little between the large cap, mid cap, and small cap. That too would be more from the point of view of maintaining the liquidity. But because, Neeraj, again, passives, let's say if you're adding two passive funds, they will have, their own drawbacks in terms of missing out on the value approach. Gradually, as the portfolio grows, maybe a fund with a little more, value-oriented investment philosophy can be added.
Got it. So, okay, so we've gotten a sense of how people can or cannot avoid or should or should not do. Watch out for that number, viewers. 70% below 70% is kind of the threshold for overlap, and not by that by itself it's a very bad thing, but you can reduce the number of funds, etc. My question to both of you before we wrap up this show is that for somebody who's hearing you right now and thinking that since there is advice to add diversification, keep the funds to a minimal, etc., can one opt for multi-asset funds? They've been now coming of age. A lot of people are advocating them. Fund houses are talking about them. They offer the diversification. The person doesn't have to bother about how to move between the asset classes. It also keeps the diversification proper. Is that a good option? Prableen, to you first.
So multi-asset funds, I feel, Neeraj, in itself, it's an interesting concept because you are able to get the combination of all the different asset classes. And there is definitely, I think it's able to contain the downside risk, given that, let's say, if equities are not doing well and your composition of gold and fixed income is there, definitely it will hold on to the portfolio during downturns. Having said that, it can still have a very high overlap with, let's say, the remaining part of the portfolio if there is a more large cap oriented portfolio for the investor. Because usually any multi-asset fund for the equity part of their holdings would have a primarily large cap stocks, which is fine. So if you're looking at somebody who's going to have a multi-asset fund and has a moderate risk appetite, he or she can be comfortable with this one along with another large cap. And within the large caps, because Kartik gave an example, it's very interesting to see, Neeraj, that the percentage of overlap is actually ranging from 20% to about 72% between the different large cap funds. So there are 3 to 4 large cap funds also which have a very low overlap amongst themselves. And I think so, it is not just a given that, you cannot add 2 schemes from the same category. And I think one has to actually check when you're adding, what is the composition, and it may just work for someone, having even 2 large cap funds or a multi-asset with a large cap if the overlap is not substantially high. And if it's good stocks and the comfort level is there, let's say if I'm having Reliance Industries, HDFC has the overlap, maybe I can continue.
Just a quick question though, Prableen. If an investor has too many of these large cap funds, right, is the investor better off buying the passive Nifty fund? The expense ratio is lower. You're practically buying the Nifty 50 if you don't have too much of overlap. And therefore, you're practically buying the top 50 stocks or majority of those. Might as well buy the Nifty passive fund. At least you get the benefit of the lower expense ratio.
Ideally, yes. Ideally, absolutely. I think, Neeraj, the problem is that a lot of people already have active large cap funds. And then, now with the passives and all this, discussions that we have, they want to add another fund. And then the duplication only goes up because the number of holdings is going up in terms of schemes. So yes, if somebody is starting off, like I mentioned, I think not only large cap, even in the mid cap, I feel, Nifty 150 can be picked for an investor who has a 15 to 20 year horizon very easily. It's a clean strategy.
Got it. Kartik, we'll wrap up the show with you.
One point I just wanted to add.
Sure.
So when an investor decides that he has enough duplication, how does he decide which fund to keep and which not to keep? So 3-4 things he needs to see. So portfolio overlap in itself is not the only tool. So he has to check the performance against the benchmark, the performance against the category, standard deviation, how volatile that fund is, Sharpe ratio, how good the risk-adjusted returns are. So based on these metrics, then he should be able to keep one fund and redeem the other.
No,
so this is very important.
No, fair point. And viewers, we had done a show with a professor about a year and a half ago, talking about the 6 complex ratios, if you will. Some of the information is easily available, some of the information is not. You've got to scan the fact sheet very, very carefully. But if you're really an evolved investor who wants to do it yourself and still wants to be scientifically correct, then you got to put in the effort. Else, just take the help of an advisor. Might be worth your while in time. If you're not a full-time investor and have a job to do or have a business to run and wants to do this by the side. Kartik, just lastly, very quickly, and the same question really for people who don't want over diversification or don't want to under diversify, is it a term like that? Are multi-asset funds or funds of that nature a good option for the person who doesn't have the time also to kind of analyze what are the kind of funds and what are the kind of stocks within those funds?
So my views are similar to Prableen's, that many of the multi-asset funds we see have a lot of large cap concentration. So it makes sense for the investor also to invest in mid caps and other categories like small caps. Okay. Also, Neeraj, one more point is the investing styles also differ. So sometimes some fund managers are growth oriented; they have growth oriented styles. Some have value investment styles. So it makes sense to have few fund schemes to give a proper diversification.
Sure. And viewers, I think just before we wrap up, an important point that Prableen mentioned, I mean, passive investing is coming into vogue. Suddenly you hear a few TV shows and a few shows on digital, and you feel that you need to have passive funds as well because they are lower expense. Fair call, nothing wrong with it. But try and check the diversification or the over diversification or the concentration part out there, because you might already be having some existing large cap funds in your portfolio. Try and talk to your advisor about whether you should kind of reduce some of those and compensate with them, and whether it's a good strategy or not, because it's a really important point. Just the number of people who are asking about whether to buy a Nifty ETF or a passive a fund with a lower expense ratio, that number is shot through the roof. Prableen, Kartik, both of you, thank you so much for taking the time out and throwing some light on this very important topic.
Thank you.
Thanks, Neeraj.
And viewers, thanks for tuning into this edition of the Mutual Fund Show.